Hey YouTube, I'm Jimmy. In this video, I'm going to walk through my analysis of American Express, ticker symbol AXP. This video is part of a series where I go through all 30 stocks in the Dow Jones Industrial Average. This is the second video in that series, the first being a recent analysis we completed on 3M. So, if you haven't got a chance to see that one yet, there's a link in the description below. So for those of you who haven't seen the 3M video where I first introduced this series, well, the objective of this series is to try to identify which companies look promising from an investment standpoint. At the end of the series, I'm going to do a video summarizing the companies we find to be most appealing and putting them together in a long-term portfolio. So, if investing is something you do or something that you want to do, then hit the subscribe button. Okay, so here's a quick breakdown of American Express's business. They make about 40% of the revenue from issuing credit cards and services around those credit cards to U.S. customers. About 17% of revenue comes from similar activities, except internationally. About 31% of revenue comes from global commercial services, where they have business-to-business payment platforms and they offer expense management products and local currency business cards. And then the final 12% of revenue comes from global merchant services. And what they do is they process credit card transactions and things like that. To me, it's interesting to see how companies segment their operations, and this can be useful because what you can get is data like this. In this chart, we have revenue by segment for 2017. The big bar is revenue, the small bar is net profit. And these percentages here, well, these are profit margins by segment. As we can see, their largest segment, which is U.S. Consumer Services, only generates 14% net profits, while their smallest revenue contributor, which is Global Merchant Services, has 36% profit margins. I like looking at this type of data because it provides, in theory, a way for us to guide us as to the future of the business. So in theory, if this segment is growing quickly, and we think that it will make up a larger percentage of overall revenue over the next few years, well, assuming that they can maintain their current profit margins, then in theory, company margins as a whole will rise. And if the company margins rise, then in theory, that should trade at a premium relative to their peers. So this can be an important thing to consider. That's why I like this type of data. Okay, here's some other stats that I think would be useful for American Express. First, they're trading at about $107 per share right about now. They have a dividend yield of about 1.3%. Their 2019 forward PE ratio is about 13 times 2019 expected earnings. Put that in perspective, the S&P for the same time period has about a 16 times 2019 earnings. Here are the expectations according to analyst estimates for the next few years. And just so we're on the same page, if you ever have access to analyst expectations like this, then what you could do is you take today's price of $107 and divide that by, let's say, the 2019 numbers, and what you get is about a 13 times multiple. If you wanted the forward PE for, let's say, 2020, well, you could divide the 107 by the $8.88, and you get about a 12 times multiple. Looking at their past 5 years, well, compounded annual growth rate of earnings per share was about 7.6%. Pretty good. Long-term debt is about $56 billion. That's not too bad for them considering they still have excellent credit quality. And their market cap is about $92 billion. Okay, so they have some decent numbers. And overall, they're a healthy company. They have a strong brand and they seem to have a loyal customer base. Although, this loyalty can come at a cost. On their recent earnings announcement, their marketing promotion expense grew by about 14%. And this was partially possible because of the 2018 tax cuts. They took those tax cuts and they applied it to marketing. Now this is key for them because they've faced some stiff competition from companies like JP Chase and Capital One. And this type of competition can also have an effect on pricing, which can be dangerous for margins. Okay, so now let's set the stage for the next few years. One thing American Express brought out back during their investor day in early February 2018 was they brought out the potential of connecting merchants with customers and customers with merchants. Basically, let's imagine that you have an American Express card, and well, that means that American Express knows what products you'd like, what products you return, how often you buy products, and what they are doing is, and they've already begun to do this, is they begin to offer you, the client, deals from local merchants. And during that investor day, they said that during 2017, they connected 15 million customers with local merchants. And that's, in theory, a good thing for their business because it should allow for their business to grow. Now, management has expressed their belief that this platform has the potential to spur growth for their business over the next few years. This is supported by the new CEO, Stephen Squeri, who took over in February of 2018. To me, this line of thinking makes a lot of sense. But I also believe that American Express continues to face some issues. And that goes back to the competition that I mentioned before. See, American Express's bread and butter has always been its ability to service the high-end client. Basically, anybody with great income if it's a person, or great revenue if it's a business, anybody with really high credit scores. Basically, those people want a premium product, and this has led to a strong loyalty to American Express, as American Express has always been the one to provide the best rewards programs and the best customer service. Well, a few years ago, JP Morgan, Capital One, and anybody else who had the ability to go after those high-end clients started doing just that. And then American Express lost some big deals, like the Costco deal, where they used to have an exclusive as the only credit card that Costco would accept, and then a few years back they lost it, and the market started to freak out about it. Well, since then, they've tried to refocus their brand and refocus on customers and providing great service and promoting what they're offering. And from a business perspective, I believe that they've done a good job of fundamentally creating a solid future for their business. Okay, now this leads us towards valuation. Right now, American Express is trading at a PE multiple of about 13 times, while the S&P 500 is at about 16 times. Therefore, that means that American Express could be undervalued. But here's my hesitation. It seems to me that digital payments, think platforms like Venmo or PayPal, are increasingly important in the coming years. So if we were to look out, let's say 5 years, can we confidently project where American Express's main business will be? How many competitors will be there? How has the landscape of the industry shifted? Is there more competition? Now, even if there was just more competition, which it seems likely that there would be, that would in theory drive down margins. That could be an issue. Now, I can safely say that I think that American Express is better off now than it was, let's say, back in 2015. But I still don't think it should be trading where the market is at. There are still too many questions for me as to the long-term sustainability of their margins. And that being said, I actually think that the 13 times 2019 earnings that they're currently trading at, maybe 14 times 2019 earnings, seems fair. That puts their fair value right around where it's currently trading. So based on my research, if I owned American Express right now, I'm not sure that I would sell it. But the purpose of this series is to create, let's say, an ideal portfolio. And I'm not sure American Express is going to make that portfolio. And this actually brings me to a different point that I now realize I may not have clearly pointed out in the 3M video that I did. And that is that I think that it's really tough to say that I like 3M or I like American Express or any company for that matter without putting it in context. I mean, if you look at American Express in isolation, it's a great business. They have a great brand and they're likely to be around for a long time. But if we were going to build a portfolio, shouldn't we have the companies in that portfolio that we believe will perform the best? That makes all investing a relative thing, since we all have a limited amount of capital and the goal of our portfolio is to put our money to work in the best possible investments. So without waiting until the end to see what the entirety of our research tells us, how can we fairly say that this investment is good or that one is good or whatever it might be? So I apologize if it comes off like I'm holding out on the ideal companies or to present the ideal portfolio. That's really not what I'm trying to do. What I'm trying to do is I'm doing the research as I go. I do the research, I create the video, and then I do the next company's research. And what I'm picturing at the end is that what we'll have is we'll have a playlist of, let's say, at least 30 videos, each one analyzing a different company, and then we can say, okay, let's try to put all this together and try to build a good dividend portfolio or a good growth portfolio, and at least we would have some material as a starting point to put together what we consider to be a great portfolio. But if I did each company analysis in isolation, well then I'm guessing, because all these companies are in the Dow, that they're probably really good companies. And what we would end up with is we'd end up with 30 videos touting how great each company is, and I feel like that would offer less value. But I'm not sure. What do you guys think? Do you like the way we're doing it? Do you like the way that we're not really presenting the finished product until we have a finished product? Let me know what you think in the comments below. And if you made it this far, don't forget to hit the subscribe button, and I appreciate you sticking around to the end, and I look forward to seeing you in the next video.